Hey there, and welcome back to our channel. If you're new here, I'm thrilled you decided to join us today. Here at Channel Name, we explore the fascinating world of finance and investing, breaking down complex topics so that everyone can understand them. Today, we're diving into an essential concept that every investor should know: stock valuation. So, whether you're a seasoned investor or just getting started, stick around because this video will help you make more informed investment decisions. Let's get started. Now, before we jump into the nitty-gritty, let me ask you a question. Have you ever wondered why some stocks seem to soar while others plummet? What determines the price of a stock? Well, that's where stock valuation comes into play. Stock valuation is essentially the process of determining the intrinsic value of a company's stock. It's an estimation of what a stock should be worth based on various factors. Investors use this information to make decisions about buying, holding, or selling their shares. But how do we arrive at that number? Let's break it down into three primary methods: the discounted cash flow analysis, the comparable company analysis, and the precedent transactions method. First up, we have the discounted cash flow analysis. This method is based on the principle that a company's value is essentially the sum of its future cash flows, discounted back to their present value. Let's say you're looking at a company that is projected to generate $100,000 in cash flow next year, $120,000 the year after, and $150,000 in the following year. To find the present value, you would discount those future cash flows using a discount rate which typically reflects the risk of the investment. For example, if we use a discount rate of 10%, the present value of those cash flows would look like this: year 1, $100,000, caret 1 equals $90,909. Year 2, $120,000, caret 2 equals $99,173. Year 3, $150,000, caret 3 equals $112,697. When we add those present values together, we get an intrinsic value of approximately $302,779 for the company. If the stock is trading below this value, it might be considered undervalued, whereas if it's trading above, it could be overvalued. Next, we have the comparable company analysis, often referred to as e-comps. This method involves evaluating similar companies in the same industry to determine a reasonable valuation for the target company. Let's say you're analyzing a tech company. You might look at other tech companies with similar revenue, growth rates, and market conditions. If the average price-to-earnings ratio of those companies is 20 and your target company has earnings of $5 million, you might estimate its value as average P/E ratio x earnings equals $100 million. If the stock is trading for less than $100 million, you may conclude it's a good buying opportunity. Lastly, we have the precedent transactions method. This approach looks at past transactions involving similar companies to gauge what buyers have been willing to pay. For example, if several companies in the same sector were sold for an average of 12 times their earnings, and your company is earning for $1 million, you might value it at average transaction multiple X earnings equals $48 million. By analyzing these past transactions, investors can get a sense of what the market might pay for the company today. Now, keep in mind that stock valuation is not an exact science. It's influenced by numerous factors including market conditions, investor sentiment, and economic indicators. But understanding these methods can help you make more informed decisions and potentially maximize your investment returns. In summary, stock valuation is a crucial tool for investors looking to assess the worth of a company's stock. By using methods like discounted cash flow analysis, comparable company analysis, and precedent transactions, you can get a clearer picture of whether a stock is overvalued or undervalued. If you found this video helpful, please give it a thumbs up and share it with your friends who might be interested in investing. Don't forget to subscribe to the channel name for more educational content on finance and investing. And remember, the more you know, the better decisions you can make. Thanks for watching, and we'll see you in the next video.